right? Last year, Bitcoin produced 164,000 new Bitcoin. ETFs bought something like 350,000. Why didn't the price go parabolic? And the answer is just wait. We're in year 2 of ETFs. I'm not saying it's going to exactly follow the gold chart, but that would mean that year 3 would be a pretty good year, and year 4, the price would go parabolic. But the parabolic is coming. As long as the ETF demand strongly exceeds new supply, the sellers will eventually be exhausted. They don't have infinite Bitcoin to sell. And I really just, you won't know when this moment is coming until it's there. But you do know that the law of supply and demand is a fixed law of the universe. It doesn't bend. And as long as that demand is persistent, eventually you get the 2025 gold year. And I think it's coming in Bitcoin. I don't know when, but I think it's coming.
Why hasn't Bitcoin gone parabolic yet? If you've been following the numbers, it feels like a glitch in the matrix. In 2025, Bitcoin ETFs were buying 2 to 3 times the total new supply being mined. The demand was overwhelming, yet the price didn't explode. To the average retail investor, this looks like a failure. To Matt Hougan, the chief investment officer at Bitwise, it looks like history repeating itself. In a revealing sit-down, Hougan explains that we are currently living through a structural absorption phase, the exact same phase that preceded gold's historic 60% breakout. Everyone is talking about gold's massive run in 2025, but most people are getting the why wrong. The common narrative is that central banks started buying gold in 2025, causing the spike. Hougan points out that the chart tells a different story. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
We actually had a central bank in the office here at Bitwise, and we were chatting with them about this yesterday. And I made this point to them. Everyone talks about gold's parabolic move in 2025, up 60+%. And they ascribe it to central bank purchases. But I showed this this chart, which is the central bank purchases lifted 3 or actually 4 years ago, right? They came in 2022 when the US seized Russia's assets, and central banks around the world were like, whoa, I don't actually own the treasuries I thought I owned. I better own something that I can hold directly. And they started buying gold. You can see here it went from roughly 500 tons to roughly 1,000 tons. But the price didn't move in 2022. It was up like 2%. And then that demand persisted in 2023 and the price went up like 11%. And the demand persisted in 2024 and the price went up like 27%. And it's persisted in 2025. And that's when we went parabolic. And the reason I keep harping on this is the number one question institutions ask me is ETFs are buying 2 or 3x the available new supply of Bitcoin, right? Last year, Bitcoin produced 164,000 new Bitcoin. ETFs bought something like 350,000. Why didn't the price go parabolic? And the answer is just wait. We're in year 2 of ETFs. I'm not saying it's going to exactly follow the gold chart, but that would mean that year 3 would be a pretty good year, and year 4, the price would go parabolic. But the parabolic is coming. As long as the ETF demand strongly exceeds new supply, the sellers will eventually be exhausted. They don't have infinite Bitcoin to sell. And I really just, you won't know when this moment is coming until it's there. But you do know that the law of supply and demand is a fixed law of the universe. It doesn't bend. And as long as that demand is persistent, eventually you get the 2025 gold year. And I think it's coming in Bitcoin. I don't know when, but I think it's coming. And when you look at the options data or when you talk to large time sellers, there's still a lot of Bitcoin for sale around 100K. I don't think we're free of this range. So I don't think those technical people are necessarily wrong. I think where I would differ, and I will be wrong if I get this wrong, is I don't think there'll be a 60% retracement from all-time highs. I don't think we're going down to 60K or 50K before we go higher. I think we're more in a range. But could we be in a range until September and then up? Yeah, absolutely. We're in a bear market. The market's down 30+%. So they were right in that sense. Kudos to them. I don't think we go minus 60, but you're right. It could be that they are right for a year and then we go higher. I just don't know when that happens. So for me, what I do is, you just hold or buy more if you have more capital and wait for it to happen. If your time horizon is 10 years out, who cares? But yeah, they could be right and I could be right. Both of those could be true.
Why
Yeah.
do we need ETFs when we have these nice stock indexes?
Yeah, I think there's two reasons depending on your starting point. So if your starting point is you have 0% exposure to digital assets, you're actually missing a part of the market, right? The equity market's 110 trillion, crypto is a $3 trillion market. A neutral position is like 2.5% crypto versus what you're holding in equities. So if you're starting at zero, that incremental dollar should go into digital because you want to at least have some exposure to the area of the market that Harvard Endowment has its largest position in, that the Abu Dhabi Sovereign Wealth Fund has its largest position in, that Ray Dalio says you have 15% in. You have zero right now. So the incremental dollar needs to go into digital just so you catch up with the market in case the bulls are right and this runs away. And if it doesn't, your other $99 are already in equities. You'll be fine. So I think that's a really important point. In terms of the marginal dollar, look, I think the risk-adjusted outlook for crypto is extraordinarily strong and better than the risk-adjusted outlook for the S&P 500. I have more concerns personally about sort of the circular revenue in AI than I do about the long-term threats to Bitcoin, right? Do I think governments will keep spending too much money? I think they will. Do I think the technology will keep working? I think it will. So I think Bitcoin is just better from a risk-adjusted long-term perspective for that incremental dollar. But I actually think the bigger deal is many people are at zero. And if you're at zero, you're short the market. You don't want to be short this market. You want to be at least neutral. So you need to get that extra dollar in. So I still think our index fund, which turned into an ETF late last year, has the potential to eventually be a $100 billion fund. It's about $1 billion today, a little bit less. I think it'll be a $100 billion fund because many of the institutional investors we speak to don't want to pick and choose between Bitcoin, ETH, et cetera. They just want to own the market. I know it's a boring answer, but I think that will do well. On an individual asset perspective, I can't speak to any specific ETF, but I can speak to the assets that underlie these ETFs. I do think, since he raised Chainlink, I do think Chainlink is one of the Mount Rushmore assets of crypto. I think it's one of the 4 most important assets in the crypto market. It's at a relatively low valuation. It very much appeals to institutional investors because it's very real world oriented. It's very tied into stablecoin growth. It's very tied into tokenization growth. It's very tied into DeFi growth. I think it belongs there up in the firmament. I think anyone allocating crypto with a 0% exposure to Chainlink is missing a big piece of the market. And so of the remaining individual assets out there, I'm pretty excited about Chainlink. I'm also excited downstream about some of the DeFi protocols where I think the token economics and governance rights are getting much better, and those may be revalued to reflect that in the future.
The most technical, and perhaps most scandalous, part of Hougan's analysis involves the stablecoin legislation. He explains that stablecoins are effectively narrow banks. In a traditional bank, you deposit money and they lend it out 10-to-1, fractional reserve banking. A narrow bank or a stablecoin like USDC takes your dollar and buys a short-term US Treasury. It is, by definition, safer than a traditional bank account. The reason politicians and community banks have fought against stablecoins paying yield is simple: fear. If you could hold a stablecoin backed 1-to-1 by treasuries and earn 5% interest, why would you ever leave your money in a local bank that pays you 0.01%?
The big question, or one of the big questions that was preventing this bill, is whether the holders of stablecoins can earn yield on their money, which obviously they should be able to. But banks, and particularly community banks, don't want that to happen, because if you can hold a stablecoin that's 1-for-1 backed by short-term treasuries and earn interest, that's a better deal than holding money in a bank that lends it out to yahoos and does fractionalized banking and doesn't pay you interest. So the banks didn't want all their money to flow into stablecoins, so they pushed to prevent stablecoin issuers from paying interest directly to holders. What this bill says is that they can't do it, but it does have carve-outs for platforms like Coinbase and others who are where those stablecoins tend to aggregate to provide yield for things like opening accounts or doing certain activities or providing liquidity. There's like 8 things they can do to provide yield. My gut tells me that this is a good compromise in terms of getting the bill through. I think that's why Polymarket odds rebounded, because people will find a way around these regulations. Yield is like water, it flows downhill. It will find a way into the pockets of crypto investors through various gimmicks that Coinbase and others will offer. So I think this is like it's a facade. It's not actually going to block the yield. I think Paul's doing a good job there. I think the right to self-custody is key. The right to be able to do peer-to-peer transactions are key. It's from a crypto perspective, the idea that those could not be allowed seems absurd. Those are like natural laws that we assume were passed down from the beginning. But of course, that doesn't have to be the case. And the most surprising piece, I think, is the positive parts on DeFi. There were a lot of concerns on how liable open source software developers would be for the work they put into building DeFi protocols. And if those protections weren't in there, DeFi was just dead. Like there was no DeFi. No one was going to sign up for unlimited liability on something they won't even control in the future, right? It sort of killed that idea. The fact that those protections are in there are a very big deal. And then more generally, it's just a broad architecture of how crypto will be regulated. To me, that's the biggest thing. We're in this pro-crypto regulatory environment in the US, but it is a castle built on sand because under a new administration, the regulators can change and do change, and they could take a strictly different view. The way to constrain that change is through legislation. So the core of this bill is just the core of how crypto is regulated going forward. And that's why it's so important. But yeah, positive DeFi, that's a big win. Positive self-custody and peer-to-peer transactions, that's a fundamental right, had to be in there. And then the stablecoin yield thing is annoying. And it's absurd that politicians are protecting banks from giving people interest.
Yeah.
It's like a crazy idea. But we'll take it because there's enough ways to work around it.
Why would they prevent stablecoin yield? Is it like, do they want their own stable coins out there to earn so that they can be the ones issuing that instead of the current companies? How does that work?
Yeah, I'll give you a Matt Hougan finance history tour. There's actually there's a long history of this through something called narrow bank proposals. So the way banks work, are fractionalized reserve. You deposit money and then they lend it out effectively tenfold. They don't keep much of the money there. And it only works because people don't withdraw their money. If there is a big withdrawal of money, you have a bank run, the bank collapses and the government has to step in. And that's bad. For years, people have proposed quote unquote narrow banks. What a narrow bank would be is you deposit money and they buy short-term US treasuries, which are the most liquid, secure financial instrument in the world, right? Government debt that's 30 days or less, always going to be repaid. And that is it. But the Fed has consistently denied these narrow banks for the last 30 years, just rejecting them out of hand. And you might say, this is crazy. This would be the safest place to keep your money. Why does the Federal Reserve force American citizens to put it in a less safe ecosystem? Their argument has been that in any crisis, all of the money, if these narrow banks existed, all of it would withdraw from the existing system and go into the narrow banks. And so one collapse at a small bank, at Silicon Valley Bank, could have taken down the entire US banking system. That's the argument against narrow banks. Stablecoins are effectively narrow banks, right? When you give money to a stablecoin issuer, they just buy short-term treasuries. That's why Circle, from my view, is safer than JP Morgan Chase as a bank account because it's backed one for treasuries. So the worry was if these were allowed to pay interest, they would just be strictly better than existing banks. And all of the money would come out of banks and all of it would go into stablecoins because it's a better experience. And that would be bad for banks. Arguably, if you think banks play a key role in credit development, bad for the economy, bad for mortgages. And that's the banking argument. It's wrong. We can talk about why it's wrong, but that's the argument. That's why people have pushed against this, right? Because the banks are afraid they'll lose all their deposits, they'll lose all their money, and they'll effectively lose their reason for being.
Are banks not currently afraid that they're going to lose a lot of capital to crypto?
Definitely, and they are.
Yeah.
Yes. So when you're falling down an ice slope, you keep throwing your pick to slow your descent. That's what they're doing. They're trying to slow their descent, and I don't blame them, right? Obviously, they're protecting their profit margins. They don't want this new competitor. They see a way to restrict it because crypto still has this risky label. What's really shocking is it's so anti-consumer. Because I just made this argument, which is all about what's good for the banks. What's good for you, what's good for me, is the ability to earn interest. Like it's crazy that the government creates inflation and then is preventing us from earning interest to protect ourselves against. This is wild.
That's right.
And politicians are doing this brazenly. They're just saying it. It's like we're in this alternate reality where you want to shake these people and say, why are you protecting Jamie Dimon instead of someone in Iowa? Like, let's help the person. And it's crazy to me. It's an upside down world. Every example I can think of in technological history ends with the technology winning. The one that's coming to mind right now is e-sign or DocuSign, which was initially not at the same legal robustness level as traditional wet signatures. We used to talk about wet signatures, which sounds really weird, but you would need a wet signature on a document. It's crazy. Now the idea of like signing a document and mailing it's a crazy idea.
Wild.
Ultimately, the faster, cheaper, better, easier technology always wins. And that's what will happen here. It's all going to stablecoins. I think, give me a long enough time frame and 100% of payments are on stablecoins, and stablecoins are our primary bank deposits because it's just a better, faster, cheaper technology. But again, the banks are sliding down that slope and throwing the ice pick to try to slow their descent. And I don't blame them. That's their job. But they're a dead man walking from this perspective.
Matt Hougan isn't promising a moonshot tomorrow. He's looking at a 10-year horizon where 100% of payments are moved via stablecoins, and Bitcoin has fully absorbed the price-sensitive sellers. The range-bound price action we're seeing isn't a sign of weakness. It's the sound of the market digesting hundreds of billions of dollars in new demand. The law of supply and demand doesn't bend. And if the gold blueprint holds true, the parabolic moment is a matter of when, not if.